Hey there, welcome back to Funded Trading. Today we're talking about something you see every day on the charts, but most traders don't really understand: liquidity. If you're tired of getting faked out or want to know how big players actually move the market, you're in the right place. So what is liquidity? In simple terms, liquidity is just where all the money is sitting on the chart. It's where a bunch of buy and sell orders are waiting. Usually, these spots are around support and resistance level, trend lines, or places where price has turned before. Big traders, like banks or institutions, want to fill huge orders. They can't do that in the middle of nowhere on the chart. They need to find places where a lot of people have orders stacked up. That's why you see the price go to those obvious levels before making a big move. Let's talk about support and resistance. When you see price hit a level over and over, that's where traders are placing orders. Lots of people put their stop losses just above resistance or just below support. That means there's a ton of liquidity sitting there, money waiting to be taken. Big players know this, so sometimes they push the price just past these levels to grab all those stop losses. That's why you'll see the price break out for a second, hit your stop, then reverse right after. That's called a stop hunt, and it happens all the time. Trend lines work the same way. If a price keeps bouncing on a trend line, people are watching it. Some traders are buying it, some are selling, and some are placing stops just below or above that line. When the price finally breaks the trend line, it often rushes to grab all those stops, then might reverse or keep going, depending on how much liquidity was there. Now let's talk about failed breaks and fake outs. Sometimes the price will try to break through a level, but can't close above it. You'll see a wick on the candle, but the body doesn't make it through. That wick means the price went there, grabbed the liquidity, but didn't have enough power to stay. So it comes back. These spots are important because the price often returns to these levels later to grab more liquidity. You also have inducement. This is when the price gets close to a level, but doesn't actually touch it. It's like teasing traders to jump in early. Once enough traders are in, the price finally tags the level, takes out the stops, and then makes a real move. You need to be patient and not jump in just because the price is almost there. And then there's the classic liquidity trap. That's when the market tricks traders into thinking it's breaking out, maybe by moving above resistance or below support, just to reverse right away and catch everyone off guard. The whole point is to trap as many traders as possible, grab their money, and then make the real move. If you know where liquidity sits on the chart, you can plan your trades better. Instead of buying right at resistance or selling right at support, you can wait for those stop hunts or fake outs. When you see the price grab liquidity and then snap back, that's often the real move. It's also super important for prop firm challenges because you can't afford to get stopped out over and over. Understanding liquidity helps you avoid those traps and trade smarter. If you want to stop getting caught in fake breakouts, or you're tired of seeing the price grab your stop and leave you behind, start watching for liquidity zones. Look for places where a lot of people have their orders stacked, and don't jump in too early. If this video helped, hit like and make sure you subscribe to Funded Trading for more real talk on trading, prop firms, and how to level up your trading game. I'll see you on the next one.